Hi, I'm Adam DeSanctis. Welcome to MBANow. There's been a great deal of attention paid lately to commercial real estate given current market conditions, and that's why it's important to look at the data. And we're going to do just that. I'm here today with MBA's Jamie Woodwell. Jamie, thank you for being here today.
Thank you, Adam.
So the Federal Reserve just last week at its 9th consecutive meeting hiked interest rates once again. How have their efforts to tame inflation impacted the commercial real estate markets?
Yeah, it's one of the central sort of activities and questions right now is the Fed has been very active in trying to get inflation down. It's been coming down, but it's still above their 2% target and probably will be for a while. So we've seen those Fed increases. When it comes to commercial real estate, what that's meant most directly is as they've raised their Fed funds rate, short-term interest rates, that's meant that adjustable rate loans and other shorter term mortgages rates have gone from what would have been sort of a base rate of 0 back last February to up in the 4% range now. So a marked impact on those shorter term loans. What it's also done though is it's spilled over to the longer term rates. So when you think about a 10-year Treasury yield, it's really sort of based on what people expect interest rates to be over the next 10 years, those short-term rates. And as those shorter-term rates have come up over the last year, we've seen the 10-year Treasury come up as well. So if last February it was just sort of in the 2% range, now it's up at the 3.5% range. So that's having an impact on commercial and multifamily mortgage interest rates as well. There's one other important factor, which is that those interest rates tend to be sort of a lower bound for investment hurdles that investors across equity and other options might be looking at. And so to the degree those rates have come up, it's put pressure on other yields as well. So when you think about a capitalization rate for a commercial property, it's been feeling upward pressure as well. So all of that has led to, again, higher costs for financing and actually putting equity into commercial real estate.
You mentioned higher costs, and we've had low rates for several years now, and the markets has been for the most part used to that, and now we're seeing a rising interest rate environment. So what does our data show us in terms of in the last couple of years of borrowing lending activity, the different capital sources and the debt that they're holding?
Yeah, great question. We just came out with our quarterly analysis of commercial and multifamily mortgage debt outstanding. There's about $4.5 trillion of commercial and multifamily mortgage debt across different capital sources. Banks, which have been getting a lot of attention, hold about 38% of that total. You have the GSEs and FHA, life insurance companies, CMBS as the other major investor groups. There's a lot of questions about what exactly is commercial real estate. So we just came out with a chart of the week recently that really details, particularly on the bank side, some of the different definitions of commercial real estate. What we tend to focus on is income producing properties. So those are properties that an investor has built or purchased with the intent of leasing out that space and getting income. The property value is based on that income, the entire business plan and the loans are based on that. Some other definitions of commercial real estate from the Federal Reserve and others draw in other types of loans, maybe construction and development loans, which includes a lot of single-family activity, maybe owner-occupied loans where a company takes out a business loan and they pledge their property as collateral. So there can be a lot of noise in that data. We try and strip that out, so we're really focused on that income-producing property that we think those of us who talk about commercial real estate, that's really what we mean.
That makes a lot of sense. And looking at those loans that are coming due this year and in coming years, and a lot of people are focused on that as well. What does that mean in a rising interest rate environment?
Yeah, we think that those maturities are really going to be the place where properties sort of test this new market. That if you look at what's happened with interest rates, with some questions about property valuations, and then some questions about property fundamentals, what's going on in the office market, apartment market, others, those questions have led a lot of folks to just sit on their hands and not sell a property, buy a property, refinance unless there's a reason to. So we think those maturities are going to be a reason to. If you look at commercial mortgage debt, it's a relatively long-lived asset. So a lot of loans are 10-year loans, so maturities are spread out. When we look at 2023, we see about 16% of the total outstanding balance of commercial multifamily mortgages coming due this year, but it's a little bit splotchy. So you've got more office and hotel loans. A greater share of office loans are coming due this year, and hotel loans are coming due this year than you would see of multifamily loans. By capital source, when you look, very small share of Fannie, Freddie, FHA loans coming due this year, small share of life insurance company loans coming due this year, but greater shares of bank loans, investor-driven lender loans, and CMBS loans. So different places you're going to see higher and lower sort of percentages of loans coming due.
Now let's talk about the different property markets of commercial real estate. We spent a lot of time on office. Last time we were here, we talked about our white paper. But the different other sectors, what are we seeing there, and how are some of the challenges and opportunities differ from what we're seeing in the office market?
Yeah, when it comes to the different property types, office far and away is getting the most attention. There's just so much uncertainty about hybrid and what future demand is going to be, and it's questions. No one really knows how much space per employee companies are going to end up wanting when we're sort of at more of a stabilized place in a year, 2 years from now. So lots of questions about office that's leading a number of investors, a number of lenders to sort of pause on that. When you look at other property types, each one has a slightly different story. Retail is a place where, sort of like office today, it had been painted with a really broad brushstroke back during the pandemic, but now folks have started to really differentiate and look at Class B malls very differently than they are grocery anchored retail centers. When it comes to property types like industrial and multifamily that have been two of the darlings, they're incredibly tight markets right now. There's a lot of new development coming online, sort of in response to how tight those markets have been. So we'll see some changing dynamics going forward, but again, right now those markets are super tight. So again, office is really going to continue to get the most attention as there's just uncertainty about how to approach any particular office right now, and sort of what one should think about for its cash flows going forward.
And finally, let's talk about the outlook. What to expect the rest of the year. You've shared a lot of great insight and commentary with us today. What do you expect the rest of this year?
Yeah, I think what we're looking for is that we've seen sales transaction volume and mortgage originations really fall off beginning in the middle of 2022. And so there's a bit of a logjam in the market. And so what we're going to be focused on is what breaks that logjam and when. We think maturities will be a key part of that, but when exactly there's a little bit more clarity around where property values are, about how buyers and sellers are coming together around where those values are. I think that's going to be the key thing to look for this year.
Thank you, Jamie. As always, I've enjoyed this conversation. And if you're interested in more of the research from Jamie and his team, go to MBA.org/research.